zooming out, so you go to war with the army you have, and do we live in a Ponzi financial system where everything is, gamed and juked and full of predators preying on the guys who don't have insider information? Yes, all of that is absolutely true. However, this is the world we live in, and so you make the best of it. So, I would without a doubt prefer that we just get rid of the Fed tomorrow. Markets would crash. The financial system would completely implode because it's, 10 to 1, 21 leverage. Good riddance. Should have happened in 2008. But having said, the odds of that happening the next year are very low. And so in the meantime, I play the AI bubble and I hedge with gold and Bitcoin.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Suddenly, signs of systemic stress are cropping up all around us. In the public debt markets, credit spreads are on the rise after years of dormancy. In the private credit markets, defaults and counterparty risk concerns have moved to the forefront. Volatility has returned to the stock market as doubts of AI spending sustainability mount. And worldwide, suspicions of fiat currency debasement are going mainstream. So, where's all this headed? To discuss, we're fortunate to welcome macro, market, and monetary analyst Peter St Onge to the program. Peter, thanks so much for joining us today.
Thank you for having me on, Adam.
Hey, Peter, so we got to meet in person the other week at the New Orleans Investment Conference, and you were on, I think, a number of panels there, but I definitely got to sit and watch you on one. Was very impressed with how you handled yourself, and we got to talking in the green room and said, hey, let's get you on Thoughtful Money. So thank you for making this happen so quickly.
Yeah, thank you for getting me on. I've been interested in coming on for a long time. I've been following the show for a long time and love, the way you approach things and break them down. So yeah, excited.
Oh, all right. Well, thanks. All right. Well, look, then why don't we just roll up our sleeves and get into it? So would like to talk to you kind of about all the themes that I just mentioned there in the intro. But before we get specific, since it's your first time on the channel, let me hit you with my general starter question, which is, what's your current assessment of the economy and financial markets?
So it's always scary to give a big picture because you are implicitly valuing things, right? You're implicitly predicting, let's say, that stocks will go up or something like that. So I think this is why a lot of commentators sort of try to dodge the point and they try to stick with the small things so that they never have to describe the entire elephant. But having said, I am broadly optimistic about the economy. I think we're in mid-cycle. I do not think we're in late cycle. The liquidity indicators, the M2 GDP is on fire. Just, when you look at the macro, it's popular, I think, for a lot of commenters to sort of say that the sky is always falling. But if you look at the big numbers, I think right now we're actually in a pretty good spot near term. So talking the next 2 or 4 years. Now, of course, long term, we're a complete disaster. We're a train going off a cliff because of the fiscal collapse. But I think near term, we're doing pretty well. And I think the biggest stories on that are really 3 things. So one of them is that the Fed is no longer afraid of inflation the way they were after the Biden inflation they created. So they're, cutting. They just ended QT, or rather that's going to end in 12 days from now. So that's going to be a burst of relative liquidity coming to the market. Number 2 is one of Trump's negotiating goals in his trade deals has been to bring foreign investment into the country. Mm-hmm. And, he talks numbers like 7-8 trillion. Who knows if it'll get that big, but, if you look country by country, so like Japan is supposed to put $1 trillion in, Europe is supposed to, I think, $1.5 trillion. Every country is supposed to put these huge numbers in.
Saudi Arabia just yesterday upped it to $1 trillion. Yeah.
Yeah, exactly. Right, and you add those up, and they're really enormous numbers. So to put that in perspective, in a normal year, all of the investment in the entire economy, and keep in mind the U.S. is 1/4 of world GDP, right? And all of the investment in a typical year is about $4 trillion. So if you're literally doubling that over the next, coming year or 2, that is just a tremendous amount of investment coming in, and a lot of that, some of it they're putting it into American energy assets that are, relatively cheap. A lot of it is coming in for import substitutions. So, this is very similar to what happened in the 1980s, where Japanese car companies, they were threatened by Reagan's trade sanctions, and so they moved production to the U.S. And so now Honda is one of the most American cars. I think like Honda content is literally higher than it is for Ford or GM. So anyway, we're seeing something like that where you have, companies like Taiwan Semiconductor. You have these companies that are coming in, building factories here. So that production is happening in the US. So that's under the tariff umbrella. So when you put the Fed together with the investment, and then on top of that, you have this just tremendous growth in AI. So AI capabilities are growing something like 10x per year, right? And that's a shocking scale, right? If you look back to the computer revolution, the internet revolution, you were talking something like 1.5 times per year. That was Moore's law. AI capabilities are going up 10x, and Elon's floating AGI, artificial general intelligence. He's pushing very hard on Tesla now for robots. That was part of his big pay package the other week, where I think he gets a $1 trillion payday if he hits all these goals. But some of those goals involved mass market of robots. Of course, those robots have AI brains, so they can do brain surgery, they can fix the stuff in your house, they can fold your laundry, they can walk your dog. So when you put these together, right, you put the technology, the Fed, and this tsunami of investment coming to the US, I think we've got a very, very good growth story over the next couple of years. Now, the concern is that every single one, well, most of those things also make inflation go up. Right. So that is the big question. And of course, if inflation starts taking off again, then the Fed is at this point probably going to be on a hair trigger. And so, broadly speaking, every point that rates are hiked costs about 1 million jobs. Every trillion of investment creates about 1 million jobs. So I think that, if inflation starts coming back later this year or sometime in 2026, then we could sort of see a tug of war between those two factors. But at the moment, GDP is growing at 4%. A lot of the apparent job weakness that the mainstream media loves, a lot of that is deportations or federal layoffs, both of which are spectacular for the country in terms of wealth, even though they might show up as lower GDP or jobs. So I think we're actually in a pretty good spot.
Okay, so that's the economy, and I do want to scratch at some of those things. How about the markets?
Yeah, markets are catastrophic for the past 2 weeks. I think it was the first day of the New Orleans Investment Conference that they collapsed. Up until then, they had an amazing year. I think the S&P was up 18% or something in the first, 10 months of the year. I think what's happened over the past couple of weeks is mainly that the government shutdown and job slowing had markets expecting that there was a Fed put, that the Fed would jump in, they would parachute in and spray trillions of dollars at everything that moved. I think that that's really what was kind of boosting markets during the shutdown, because it was strange, right? Like we saw markets go up almost immediately when the shutdown began. And whatever you feel about the federal government, I think it should be 10 times smaller. But that's kind of a strange movement from financial markets. Normally, financial markets don't like anything interesting to happen. They just want boring. They don't want any headlines. And that was a pretty big headline. And I think that specifically what was happening was that markets internalized expectations that the Fed would jump in and, as always, overshoot any kind of crisis. They would over liquidate. And once the government reopened, well, first you had Powell saying that the rate cuts in December were not a foregone conclusion. That started hitting liquidity expectations, and then once the government actually reopened, it confirmed it. And since then, the Fed has turned fairly bearish. Talking the expectations for rate cuts, I think, are coming down, and certainly there's no more expectations of some kind of emergency pump going in, unless the federal government manages to discover a new crisis. So I think that that's the main thing. And the evidence for that is that everything went down, right? Bitcoin went down, AI went down, broad market went down, gold went down, right? So that, to me, suggests that it's liquidity driven. This is not cycle driven. Now, since then, one by one, those different sectors are starting to pop back up. So yesterday we had really good movements in silver and gold. The past, I think, 2 out of the past 3 days, AI have been strong. So I think that people are sort of sorting through all the dead corpses and seeing which ones are still alive. So that's starting to come back. But that initial movement where everything went down, I think, suggests that this was more about the Fed.
Okay, all right. So, uh, state of the markets, though. So, going forward from here, do you feel they're fairly valued? Do you have overvaluation concerns? What's your
Yeah,
general view?
they're right. If you look in historical context, they're clearly overvalued. I think there's no question that we're in a bubble in certain assets, specifically AI. AI is just completely dominated. You and I were both around in the dot-com era, and AI, I think, is substantially more hyped even than dot-com. And one of the things I mentioned at the New Orleans conference was that the trick is it's one thing to say it's a bubble, but bubbles last a long time. Like the average bubble lasts about 5 or 6 years, and they don't tend to end until liquidity cuts off. They do not end on valuation. There is no correlation between the length of a bubble and how high it gets. And so the question at this point is, are we in an AI bubble? I think absolutely. If you look at AI valuations compared to the rest of the market, if you look at it versus historical, comparable technologies, of which, we've had 500 years of stock markets digesting new technologies. You had diving bells in the 1600s, and these were really exciting because we would rediscover all the shipwrecks through the ages. And this would,
Hmm.
okay, so I mean, bubbles are a very, very old thing. We've had thousands and thousands of them. And, there's a pattern to them. They don't pop from size. They pump from broader market conditions. So until we see that, I think that the most likely, well, at any rate, the question is the AI bubble, is it going to pop today? Is it going to double again and then pop? Is it going to go up 8x and pop? Well, if it goes up 8x and pops, then it's going to end up at a value substantially higher than today, right? So if you look back at .com, for example, people were complaining about Amazon being a bubble. So I first bought Yahoo in 1996, and everybody told me it was, I was a complete idiot. Obviously, the internet was a bubble. That was 1996, right? And then Yahoo went up, whatever, 150 times. Did it fall? Yes, it fell to like 50 times, right? But that is fundamentally the question. Broadly speaking, when I see something, like when I first hear something is a bubble, I want to buy it. That just instinctively, I want to buy it. I'm not a contrarian. I want to be in it. And then the question is, at that point, then you've got to watch the broader liquidity, the broader macro indicators, because that's what's going to do the bubble in. It has nothing to do with the companies itself. If Nvidia went up, double from here, I don't think it would raise the likelihood of AI being a bubble. It's the broader liquidity.
Okay. Um, well, we'll talk about liquidity in just a little bit here. So let me make sure I heard you right and then ask a few questions. Um, so it seems like you're relatively sanguine on the economy in the near to midterm being next 2 to 4 years, like you mentioned. Um, and you've got, like you said, it's a disaster in the long term, and I'm sure that has to do with our debt levels and a whole bunch of other things we can get into if you like. From a market standpoint, I don't know. I'm gonna put you, I guess, as a question mark, which is, hey, we're in a bubble. We just don't know where we are in it at this point. And
Yep.
so until we start seeing, until and unless we start seeing signs that the bubble is really starting to implode upon itself, it's probably game on in the near term. Fair?
Yep, yep,
Mm.
absolutely.
Okay.
And given the Fed ending QT, given all that flood of foreign investment coming in, I mean, everything points to liquidity being very strong in 2026. So that argues for the bubble to keep going.
Okay. And so let me ask this question. You've kind of already answered it a bit, but I've asked it a lot and recently, and I think, it seems like we're thinking somewhat similarly, which is regardless of what you think of President Trump and the new administration, it has it has pursued it has aggressively pursued a set of economic policies designed to goose the economy, goose economic growth. And that's everything from the provisions in the One Big Beautiful Bill to the deregulation to the bringing foreign investment into the country and all the things that you mentioned. So one of the questions that I've been asking is when do you expect those to start providing tailwinds to the U.S. economy? They take a while to
Yep.
actually build up momentum so that you can actually see the impact of them. Sounds like you think we'll be seeing those tailwinds in 2026, probably increasingly as the year goes on. True?
Yeah. Yep. Yeah, I think that's accurate. A lot of it, so foreign investment, for example, if it's really 8 trillion, that's going to take a really, really long time to digest. You have to negotiate the terms, you have to find the site, you have to do the blueprints, you got to do the construction, you got the permits, you got environmentalists all over the place. A lot of the investment probably is not really going to kick in until maybe even after his term is over. But I think that a lot of these things, Fed cuts tend to have a lag of about 12 to 18 months. It hasn't really cut substantially yet, but at any rate, some of the previous cuts should start coming in. The foreign investment, the deregulatory, I think, has not been as exciting as most of us hoped. But I think, if you sort of stand out to get perspective, so the federal government has been a crap show for a very long time, and somehow the economy keeps growing, right? Point being that you don't need the government to be perfect. You just need to be not as bad as it used to be. And if that's the case, right, if you can either get rid of some regulation or if you can just slow the pace of new regulation, then you can see that start to reflect in job creation. So, regulation compared to what we hoped for is not very impressive so far. Regulation compared to what was happening a year or two ago, I think, is a huge difference. And so, we should start to see green shoots come in there, I think, during 2026. The question for Trump, well, really, the question for Washington is that the sort of biggest game for them right now is what happens in the midterms, right? So whoever wins the midterm elections, if Republicans win it, then we're more or less going to keep going like we are, possibly with a bigger lead so that, they're not held hostage as much as special interests. If Democrats win it, then more or less Trump grinds to a halt. At that point, all he's got left is executive orders. So, that's kind of the big question is that growth going to kick in time to swing the midterms? And then if the midterms don't swing, or rather, if Democrats end up winning the midterms, does that change expectations for economic growth and regulation for the following 2 years? That sort of thing is going to will start to be reflected in markets starting in, June, whenever markets start to get confident about predicting the outcome for the midterms. Current on the midterms, I think, is about 75% Democrats winning. That's because historically, for the past 125 years, the out party wins 90% of the time. So that's not particularly surprising. But that also means that markets have probably internalized that already. So if growth comes earlier, if there's some nice surprises on inflation, if you can keep it under wraps, if some of these affordability things that Trump is pushing actually get through, then that could actually boost markets that already expect the Democrat win next year.
Okay. The 75% expectation Democrats win, is that that they take the House?
The House. Yeah.
Okay. So it would be a divided Congress, not necessarily a fully Democratic Congress.
Yeah, odds on the Senate are roughly 75% the other direction. So the Republicans almost certainly hold on to them. And that's because the number of seats in play is a very small number of seats in play. And there's a lot more red states with Democrat senators than there are blue states with Republican senators. And so these things sort of even out over time, and Democrats or Republicans have a 3-seat advantage. So it's very unlikely that they lose the Senate. But if you lose the House, then you can't start new, bills.
No, right. And I think it's pretty clear that one of the reasons why the Trump administration had their sort of flood the zone strategy coming high out of the gates was because, look, we're not sure we're going to get the midterms in our favor. And so let's get as much of this stuff out beforehand.
Yep, exactly.
Yeah. Okay. So, all right. So you, again, if I'm taking good notes, you believe that we'll see tailwinds to the economy from all these administration policies kind of increase as we go into 2026. You also referenced the remarkable acceleration in rolling out of new capabilities for AI. One of the really big question marks for AI right now is, okay, we're spending all of this money, right?
Yep.
And I mean, I one man's opinion, but I think everyone's sort of looking at this like the dot-com era, like, hey, we believe this will be a real deal, like dot-com was. Now the big question is just, over what timeline is this new prosperity, this incremental prosperity going to be realized, right? And we are not seeing a ton of short-term results where people are saying, hey, we spent a lot on AI and man, look what happened to our incremental profitability, or look at what happened to our incremental revenues, right? Do you believe we'll start seeing that across 2026? Is that why you mentioned that there?
I'm not sure about that. This is something that we faced precisely during .com as well, where early on, if you can go back and look at news articles from the mid 90s, and they were just uniformly skeptical about the internet. They were saying, CEOs are just doing this because it's the fashionable thing. You got to have a website. Everybody's
Right.
losing money on the
It was
internet.
brochureware. Yeah, remember that?
Yeah, exactly. Yeah. Customers don't want to buy on the internet because they can't see you, they can't trust you. I mean, and I suspect if you went back and tallied up the early internet projects, I think Microsoft, what they found that something like 5% of AI projects pay off or something. I suspect early internet is probably the same deal. And also the build out was very similar, right? You had this circular financing where companies would lend each other the money to buy their products. I worked for a telecoms company way back then, and we did that.
Lots
We
of
were
vendor
relatively
financing, lots of
boring.
sketchy vendor financing in that sector.
Absolutely. Yep. Yeah. So I think that on a lot of metrics, AI looks, I mean, it's really kind of a repeat of .com. The question is, where are we in it? Right. So if you time .com from, let's say, the Netscape IPO, which I think was 1994, and then if you time AI from ChatGPT coming out, which was late 22, then, by that logic, we're what, in like late 1997. So we got another 1998 and 1999 to go, which you'll recall were exciting times if you own .com stocks. So that's the question. Maybe it's accelerated this time, or maybe there are other elements happening in the macro economy where it's going to go faster or slower. But fundamentally, I think that the internet and the AI story are almost identical. The question is just, where are we in that story?
Okay, yeah. So obviously that's the gazillion-dollar question here: is what inning are we here in this race? And it's unknowable, right? I mean, that's what happens with bubbles, if indeed we are in one. All right. So let me ask you this. I get your logic for why you think the economy, could continue to improve from here for the next couple of years. Let's start with AI for a second. There are a lot of it's been interesting how quickly recently concerns about AI have been multiplying, the AI trade, if you will. Are these companies too overvalued? What's going on with these circular financing deals? We had the Michael Burry, raising the concerns of, hey, there's some really sketchy accounting practices going on here with how they account for the depreciation of their chips and stuff like that. So all of a sudden, you're getting a lot more people kind of trying to poke holes and saying, I'm not really sure what's going on here. The day we're talking, the world is waiting with bated breath to hear the NVIDIA outcome. And to be honest, I made this comment earlier today. I can't really think of a time where the entire market future has hung on a single company the way that it might be doing right now with NVIDIA. And you don't have to agree with that comment. But where I'm going with this is let's just assume for a moment that the correction in the AI stock complex happens in the near future, next quarter or two, right? Can we survive that without having such a tremendous negative wealth effect that the economy actually avoid going into a pronounced slowdown, if not a recession? And I know when you said, look, the economy could do well for the next 4 years, I know you didn't mean it's just going to do better every single day and there'll be no wiggles along the way. But if the bloom does come off the AI stock rose, can we avoid a really material economic shockwave from that?
Yeah, so the comparable to that would be the 2001 recession. And I guess we had three things that happened at the same time. And so it's hard to disentangle those. One of them was the dot-com crash. The other one was the Enron and WorldCon scandals.
Yep.
And, so that's had an impact on risk and on valuations. And of course, we had 9/11. And so all of those more or less hit around the same time. Even so, 2001 was a fairly shallow recession in the grand scheme. It was nowhere near 2008. It
Right.
was closer to 1991. And so if we just have an AI implosion and nothing else, and but then if in the meantime, all these investments are flowing in, then if we will get an outcome where either it's, I think, a very mild recession, or it could actually bump off. It could just reduce growth. You might have a couple quarters where you have growth at 0.5% or 1%, basically European levels. But we might actually avoid a recession on that. Now, there is an outside factor that has nothing to do with any of these, which is that we have sort of some external factors that are going into reducing GDP growth anyway. I mentioned earlier the deportations and the cuts to federal spending, cuts to federal workers anyway. Federal spending it's much reduced in its growth rate versus Biden, but of course, federal spending never ever goes down. But anyway, those reductions reduce the apparent GDP growth rate. I would argue that they're kind of fake in the sense that, when people say GDP goes down, they're thinking that's a bad thing because we're poorer, but those two things actually make us richer. But at any rate, so, if taking it in the spirit of the question, which is that if AI were to implode, would we start getting poorer? I think that's 50-50. But taking in the sort of technical question, would we enter a technical recession where GDP was negative for 2 quarters? I think that's much more likely. But a lot of it is simply the deportations and laying off federal workers. When you deport somebody, so the example I like to use is, let's say that you annexed Canada tomorrow. Trump's dream comes true. So Canada has something like 25 million workers. Now, if you annexed Canada, if you brandished your military and said you are now a state, you would not have 25 million extra workers standing in line at a soup kitchen. Okay, everybody in Canada already has a job. They already do stuff for each other. Similarly, when you bring a migrant into the country, you don't have an extra worker, right? Because they create as much labor demand as labor supply they bring, right? So in other words, they come to the country, they work, and then they go to the dentist, they go to McDonald's, they rent a house, they get a haircut. Okay, they consume services, and the vast majority of what they earn is spent domestically. It's not sent back to Guatemala. So the point being that when you are exporting workers, or what I think is about 2 million so far that have left, when you're sending those people out, that shows up as reduced GDP. It also shows up as fewer jobs. You have 2 million fewer people getting haircuts or going to Kentucky Fried Chicken, right? So this is going to ripple across the economy. It's going to make GDP appear smaller. Well, it will actually be smaller, be fewer people in the country. It's the reverse of that.
It's less consumption in a 70% consumption-driven economy. Yeah.
Bingo, exactly. Right. So, that's kind of the trick here is that, are we talking about a technical recession where we have 2 quarters of negative growth like we had in, 2023? Or are we talking, sort of the spirit of it where the people are poor, people are desperate, unemployment goes to 7%, people are standing in soup kitchens? That, I think, is much less likely if all we get is an AI implosion. And the reason being that flood of foreign investment would compensate for it. Now, if the Supreme Court decides that the tariffs are illegal, Trump's probably going to try to do it in other ways, but that could then endanger that alleged $8 trillion of foreign investment. And at that point, yes, the odds would dramatically rise that an AI implosion would take the rest of the economy into a recession, which would, I think, be on a scale of 2001, not 2008.
Okay. All right. Appreciate that answer. And, I'm not making the argument necessarily it's going to happen in the next quarter or two. Wouldn't shock me if it did by any stretch, but point is it's just unknowable, right? All right. And so again, trying to see through your lens here, economy doing, pretty well and prospects to get better. We have this term, the K-shaped economy, which I'm sure you're familiar with. When you say the economy is doing pretty well, at a 10 people, you'd probably get 2 or 3 agreeing with you and 7 or 8 disagreeing with you right now, because it's that top half of the K that's doing great, especially those that own the assets. And it's a lot of the bottom half of the K that is increasingly struggling here. Do you expect the prospects of the bottom half of the K to get better as the developments that you're expecting roll out, and presumably all this new investment creates new jobs? Maybe it's a different type of job than had been. We've been a very service-driven economy. We've outsourced our manufacturing. Presumably, this capital coming in is going to help increase the share of manufacturing jobs. So are you sanguine as well for the shape of the economy going forward, or do you think it's becoming more of an economy of haves versus the have-nots?
Yeah, well, I think you're absolutely right. It's pretty much 3 economies, right? You've got whatever, 20% at the top, let's call it a quarter, who are doing fantastic. The Fed's been pumping their bags for 50 years. You've got 25% at the bottom who are miserable and are barely holding on. And you got the half in the middle who are squeezed. What's interesting is that since COVID, the top, the percent of consumption from the top, I think it's 20% of Americans, went from 45% to 49%. So in other words, the middle class lost about 5 points there. The percent of consumption by the bottom 20% also increased. So the bottom gained about 2%. And the reason is because there was this orgy of welfare benefits that were pushed out the door during COVID. They green stamped everything. SNAP benefits, for example, since COVID, they went up 70%. The number of poor people in America did not go up by 70%. It did not double in 5 years. So the middle class has been nibbled really by both sides. Having said, I think, if we look at what I think are the 3 big economic stories of the coming year, all of them relatively benefit blue collars, lower income. Now, that's not to say, the rich will keep getting richer because you've got a Fed, right? Like, when we were talking about what's happening with the economy right now, so the Fed dominates everything, and the Fed makes sure that no rich guy goes home hungry. So, it's entirely possible that all those trends will continue getting worse, but I think that they'll get worse at a slower pace than they have in the past. And the reason is that Trump's policies, broadly speaking, are aimed at blue collars. The tariffs are not trying to help white collars, right? They're punishing white collars, is almost the intention. They're trying to bring back manufacturing jobs for blue collars. Deportations, same deal, right? Deportations actually hurt rich people who can't get cheap nannies and lawnmowers. They're fantastic if you're low income. So, you're living out in Nebraska. You don't work at the meatpacking factory because it pays $8 an hour and it's backbreaking, but if it's paying $23 an hour, now you do. And then the final one is AI, where I think that maybe one of the surprises of AI has been that it appears to be hitting white-collar jobs. So relatively routine white-collar jobs is not hitting blue-collar jobs. Now, there may come a time when robots, bring that job change to blue collars, but first of all, that's going to be delayed, right? Robots are relatively slow, probably 7 or 10 years delayed. Secondly, robots will never replace jobs the way that AI will, because AI is software, meaning that the incremental unit is free. They'll charge money for it, but it's free to produce. It's like a Google search, right? Whereas a robot, it's going to be a long time before robots are free. And so the job replacement, I think, is going to be overwhelmingly among white collars. Most of the human wants are unlimited, so an exact equal amount of jobs will flow in. It'll take time. There'll be pain in between, but ultimately those AI or those white collar office jobs will become service jobs, where relatively poor people will enjoy services at a pace that rich people do today. So they'll hire nannies. Even today, if you look back 100 years and you told people that the poorest people in America get their nails done, get hair extensions, that's crazy, right? Poor people can't afford that. And yet here we are. So that'll all take time. But fundamentally, all 3 of those factors, the deportations, the foreign investment coming in, and the AI, all of those hit white collars harder than blue collars. Which I think is interesting. There was this fun study from, I think, 1991, and it looked at the Finnish Civil War. So this was around 1918 when the Bolsheviks were taking over Russia. And a couple of Finnish professors did a study where they looked at the class of Finnish students compared to their fathers. And what they found is that anybody born rich who was now lower status, those were the communists. Okay, anybody born poor or rich who was still either rich or had become successful, okay, those people were all the conservatives. Point being that the sort of nucleus of the revolution, of the Mamdani push in the Democrat Party and so on, these are very specifically the kind of people we're talking here, which are these white collars who had $80,000 jobs doing some kind of office work or some skilled labor that is now replaced by AI, and now they got to go be a waitress or something. Those people will get angry. So I think that these protests we're seeing, the anti-Trump, a lot of this stuff fundamentally is sort of anxiety about losing their status, and I think that will absolutely continue. So I think relative to the past 5 or 10 years, I think the next 5 or 10 years are going to be relatively good for blue collars, going to be very bad for white collars, and that's going to create a lot of white collar angst.
All right. God, I'm trying to resist digging further down on that with you, but let me put it aside just for 1 second here. So, something that you think is a key part of the equation here that's going to keep things stable and keep things supported is liquidity. We are going to have a new Fed chair in the not too distant future here. What do you expect of liquidity under a new Trump replacement of Powell? Now, again, it's ironic that Trump is so frustrated with Powell because Trump's the one who put Powell in the chair in the first place. But do you think that we're going to get somebody who's going to be a lot more dovish and a lot more quick to open the spigots going forward?
Yeah, it's tricky because when they're auditioning for the job, given that Trump has been pretty forthright about his preferences, they all claim to be extremely easy money Fed chairs, and you never actually know until you put them in there that was the case with Powell, for example. So, but still, taking them at their word, looking at their past statements, the front runners have generally been relatively hard money guys, but they've also been extremely loyal to Trump, even before there was a horse race going on for the Fed. So it's 50-50 whether they're going to be as easy as Trump hopes, or if he'll turn on them and then call them low IQ, like he does Powell. But yeah, so I mean, either way, I think that if you look at the trajectory that the Fed's on now, constitutionally, the Fed wants easy money. It always wants easy money. That's why central banks are created. The only reason why it's been relatively tight is because the Biden inflation was such a spectacular faceplant by the Fed that it was bad enough that it threatens their independence, right? That's the kind of thing that gets congressional hearings going and gets Congress to agree with presidents. So they had to keep their nose clean. It kind of scared them straight. But the memory is now fading. Inflation for the past year has been around 2.5%. At that point, they're not angry enough to get congressional hearings, since the Fed reverts to its natural form, which is inflationary. So whether or not the new guy, if the new guy has drunk the sort of Trump Kool-Aid and is truly easy money, if he tries to jack rates down, if he tries to do QE, that I think is going to be absolutely spectacular for markets, which will then crash afterwards. If, on the other hand, the guy comes in and he's more or less Powell, I still think that's positive for markets because the Fed is trying to ease because sort of as the headlines recede in the distance from Biden inflation.
Okay. So, the Fed has certainly been, an interventionary force, and usually way more often than not on the side of easing than tightening. But to your point, they've been constrained due to inflation over the past couple of years. And while they're becoming more dovish, there's still a lot more they could be doing
Hmm.
relative to what they did historically and they're doing now. And what really seemed to carry the torch in the US, but a lot of other countries too, but certainly in the US, has been the fiscal spending, right? It just went ballistic during COVID and is not really moderated much. Um, Now, with the big beautiful bill, the promise there was, okay, look, we're going to spend a lot at the beginning of the big beautiful bill, but then we're going to get all this discipline, these benefits down the road. Where do you see fiscal spending going? You know, will we actually bring it down as a percentage of GDP, or is this all just, you know, the sweet songs that politicians promise but never deliver?
Yeah, I think it's going to keep going, keep getting worse. You know, there's no sort of natural predator for spending in Washington. There's no balanced budget amendment. There's no gold standard. There's no real consequence in the near term. And you know, elections happen on 2-year cycles. There's very few politicians in Washington who are thinking 10 years out. Essentially nobody. So if it's not happening in the next 10 years, then it doesn't exist. And then meanwhile, of course, the benefits of increasing spending are massive. All of your donors like it, your voters like it, everybody likes it, the markets like it. You can get
The
that
benefits
tissue
to the
fire.
politician in the immediate term are massive.
That's
Yes.
exactly it.
Yeah.
Right. And then you combine that with, there's this great book called Crisis and Leviathan by Bob Higgs, where he talks about every time that something bad happens, the government grows and it never ever goes back. It's a ratchet, right? So if you look at every war, you know, you had the Civil War, you had World War One, two, the Great Depression, COVID. Every single one of these things expands the government and it does not go back. Generally, you give back like maybe a third. At best, you give back a half. But we never go back to the old one. And so my concern is we're eventually going to have a recession. You know, we can debate whether it's going to be 2 years or 6 years, but we're going to have one because that's how the Fed structures things. It creates business cycles. So unless we're getting rid of the Fed next Tuesday, we will have a recession at some point. My concern is that when you look at what happened during COVID, not only government just expanded just astoundingly. Also in 2008, right? If you compare those two to previous recessions, it's gotten a lot faster. The numbers have gotten a lot bigger, many, many more trillions. What specifically scared me during COVID, I was living in Canada at the time, and we had it was basically universal basic income. You know, so all of us got laid off, me included. And instead of getting your, standard unemployment benefits, you got this, is called the CERB. So you got this monthly payment, I think it was 2,000 Canadian. Now that was very decent amount of money if you're a blue collar, for example. That was part of the reason why the shutdowns were so popular in Canada specifically. But they tried here, the closest we came was the PPP. But the left, there were other countries where they also pushed UBIs during COVID. My concern is that the left, that is absolutely what the left wants. They're primed for it. During COVID, they kind of flexed their muscles. They passed it in some countries, not in this one. But I think that the left is laser focused on getting a UBI in there because that is the ultimate bread for the circus. That's the vote buying machine. That's really what the entire welfare state is about, is buying votes. If you can have a UBI in there, that's that's vote buying on steroids. Trump, if you look at him with the dividends, I'm not sure he would necessarily fight it, to be honest. So that's I think my biggest concern. If we start getting into UBI territory, we go from this sort of leisurely, decades-long collapse into something that I think goes a lot faster.
Okay, so I'm working my way towards monetary debasement. But let me ask you this, Peter, just asking for your gut opinion here. Is UBI an inevitability? Meaning at some point, Trump will be out of office. At some point in the future, there will be a more liberal administration. It seems like from what you've said, you think they would want to get the UBI playbook going at some point.
Yeah, I think it's about 80% odds. And the problem is that once you put it in, it's very, very hard to get rid of. We sort of have a UBI called Social Security, and there is zero prospect of getting rid of that. They only have to get lucky once. Once it's in there, it stays.
Okay, so 80% probability. I love the fact that you're willing to just give me these numbers.
I'm an economist.
Yeah. Okay, so well, look, you expect liquidity to remain flush. You expect the fiscal government to really never contain itself, contain its spending. Um, and so the even though we will have some growth, some incremental growth in here, you feel, um, I got to imagine the long-term trend of a lot of this stuff makes you think that the purchasing power of the currency is one of the more easy predictions to make in terms of it continuing to get debased going forward. You're nodding as I'm saying this.
Yeah, and it's similar to AI. Like the question is, what inning are we in, and what inning do markets think we're in? Right. So if you look at gold since 1970, there have been periods where gold has collapsed in half because the government turned out to be not as irresponsible as people expected. Now, there was never a period where the dollar was actually, gaining value on a sustained basis.
Right.
But there were changes in expectations of how bad it's going to get and how quickly. So, without a doubt, it could slow again. I know, again, speaking from Canada, there was this strange period in the 1990s. Actually, here in the U.S., there was as well, where we actually had budget surpluses, where Clinton and Gingrich got together and made the unicorn sing. But of course, that
Fleeting,
went
but
away
yes.
very, very quickly. Yeah, for I think it was 2 years, and then Bush needed money for wars, and 2001 happened, and it all went away. So right, there's definitely a chance that we could grow fiscal sanity for a minute or two. The key in the 1990s, I think part of it was the dot-com boom. So about half of that surplus was just capital gains taxes. The other half was that Gingrich and Clinton despised each other, could not agree on anything, which is beautiful. Every time I hear the word bipartisan, I fear. I reach for my wallet. So, I think it's a very, very healthy that the two parties hate each other. They call each other the F word. I think this is really good for, kind of the fiscal picture going forward. But having said, I mean, it's not going to improve. That is to say, it might slow a little bit because of that, because of dysfunction in Washington.
Okay. Well, look, part of why I asked that question is because it seems to be the natural progression of what you've laid out so far in terms of your outlook. But also, I know that you are a contributor to the Mises Institute, and that's very much a sound money organization. And so, and having read your X feed, uh, yeah, it seems pretty clear, correct me if I'm wrong, but it seems pretty clear that, while you're not calling for an immediate end to the AI bubble, you feel the markets are distorted and you are seeking potential shelter, hedge, whatever, both market risk and currency risk in assets like gold and Bitcoin. So am I characterizing you correctly?
Yeah, I mean, generally, what I personally do is I like to chase the bubbles, and then I have a big fat chunk of hedge, which is generally gold, and because I'm addicted to risk, some Bitcoin thrown in there. But right, the idea is that you're sort of covering all the bases, and zooming out. So you go to war with the army you have, and do we live in a Ponzi financial system where everything is, gamed and juked and full of predators preying on the guys who don't have insider information? Yes, all of that is absolutely true. However, this is the world we live in, and so you make the best of it. So, I would without a doubt prefer that we just get rid of the Fed tomorrow. Markets would crash, the financial system would completely implode because it's, 10 to 1, 21 leverage. Good riddance should have happened in 2008. But having said, the odds of that happening the next year are very low. And so in the meantime, I play the AI bubble and I hedge with gold and Bitcoin.
Okay. So the question I've been leading up to, and maybe you just gave your full answer to it, but I'll ask it just in case there's more elements to it. Um, you know, okay, you've given us your whole outlook here. What investment themes emerge from having this type of outlook? And it sounds like, what you just said is, well, hey, look, if there's a trend in play it until it doesn't end anymore. But, have some backups in your portfolio in case the trend reversal catches you by surprise. So is that pretty much how you're doing it? It's play the AI game, why that's driving everything pretty much in the market, and then having these risk off assets. Well, gold's a risk off asset. Bitcoin, I think people
Bitcoin's
really
funny.
disagree.
Yeah, right. Yep.
Yeah. They'll
Yeah,
debate
Bitcoin
it,
is
we'll put it that way.
Yeah, Bitcoin's like gold and dot coms had a baby, and so it's got some elements to it that are related to the basement, and then it's got other ones that are definitely risk off. Um, but yeah, I think follow the trend. Often a new, better trend comes along, right? So, if you were playing the trend 5 years ago, then I don't know what was hot 5 years ago. I don't know. Uranium was hot for a minute. Okay, so you could play that for a little while, but like you always want to keep an eye out. Is there some better trend to jump onto? There's lots of stuff that's coming after AI. So robots are going to hit. I think longevity is going to hit probably in the early 2030s. Typically, you know, if it's a real sort of world-changing technology, that's going to dominate the headlines for something like 5 years. So broadly speaking, my plan anyway is ride AI for a while. At some time, at some point, robots get sexier. We also, we haven't even seen the application insanity in AI yet, right? So
Right.
currently we're seeing these ridiculous multiples on the guys who are building the picks and shovels. We haven't even gotten to the stupid, some college kid comes up with, whatever, like a fart joke AI, and then it's worth $1 billion. We haven't hit that stage yet. And this is part of what makes me think that the AI thing is not done yet. Makes me think that we're closer to 1997 or 8 in the dot-com boom than we are to 2000. But anyway, right. So sort of trend by trend. In the meantime, watch the macro, watch the liquidity. As the liquidity risks get higher, then you want to raise your hedge into specifically something like gold. Watch simple moving averages, and when your trigger hits, go to gold, turn off the Bloomberg, relax for a year or two, and then see how low it gets.
Okay. And I do want to note for folks, I think you might have given passing mention to it, but as I understand your personal history as an investor, you really shoved a lot of chips on the table into the dot-com stocks during the, early to mid innings of the dot-com boom. So what you're talking about now here with the AI stocks is in many ways sort of practicing what you've been preaching, right?
Yeah,
Or or it's consistent with your previous behavior. We'll put it that way.
it is. Yeah, I've been doing this for 30 years. So in the dot com, I wiped out because I said, okay, like I got the whole Warren Buffett thing. And I was like, you know what? I'm just going to buy and hold it because the internet's real. And so I'm just going to not look at it. And I literally moved to an island in Thailand with no internet connection.
Yeah,
And I was there
you
for like
quote
two
unquote
months.
retired early, right?
Yes, I did at 25, and Thailand seemed like a good place to do it for a variety of reasons. And then I came in and looked at the stocks, and they had all fallen like 90%, which is what made me go back and get the PhD because I thought, okay, well, buying a trend is really easy because this is all the newspapers and everybody's complaining about the bubble. The question is, when the heck do you get out?
Hmm.
And that, for me, is where the macro comes in. That's where you want to know what's happening in GDP, inflation, what's the Fed doing, what's happening to liquidity, what are the tens and twos, what's high yield. So all of those things, those are giving you indicators when to get out because getting in is easy, getting out is the tricky part.
Okay. I'm curious, right now as you're playing this, I mean, the AI stocks have done extraordinarily well. Um, are you slicing off some gains this time, like realizing
Nope.
some of this stuff on the way up? You're not. Okay, you're
I'm
and
not,
first, I mean, I
yeah.
always say to people, what we're talking about here is not personal financial advice, but certainly
Mhm.
you're not giving personal financial advice here. You're just explaining what you, Peter St Onge, potential risk junkie, do.
I have a tattoo of a bull on my shoulder. I would not advise for everybody to do what I do. I love the risk. I love the thrill of the game. But to answer the question, I'm not taking out anything off the table. And the reason is because when you look at that first week of movement, where even gold got shellacked, that told me that this is 100% Fed. This has nothing to do with fundamentals. It's got nothing to do with broader liquidity. This is simply the removal of a Fed put that got put in there because of the government shutdown. So I think it's transitory. Now, having said, I could be 100% wrong. There's an old saying: the market will do whatever embarrasses the greatest number of people. So it is.
Mhm.
It would be absolutely hilarious if this is the end and then everything implodes 30% tomorrow, and then we can come back on and have a drink about it. But at any rate, but I'm not taking anything off the table for this. I think this is just an itty bitty move, and it's completely Fed driven.
Okay. All right. Well, look, as we start to wrap up here, It's been a very interesting conversation. I'm so glad, like I said, we made this happen. Thanks so much for coming on and being so specific and giving such quick, specific answers. When I ask for a probability, you give me a percentage. It's wonderful. Is there anything else that is, really burning brightly on your radar right now that you think is germane to this conversation that I just haven't thought to ask you about yet?
I think, oh yeah, I started talking about it when we were talking about the waves. So you have the AI, the robots, and the next thing after that, I think, is longevity. And longevity is something that I'm absolutely fascinated about. I think that there's going to be a ton of investment going into that. I think that AI is going to be a huge part of that in things like drug discovery. I'm that's kind of, when we talk about riding the trend in terms of like what's the next trend over the horizon, that's what I'm excited about. You have to be very careful. You can't play it too early, right? Biotech, it'll go up 1,500x and then it'll go to zero, and they almost all go to zero. So you can't play it too early. But for me, that's really the fascinating thing coming over the horizon.
Okay, and I was just about to ask. So, is the biotech sector sort of primarily where you think you're going to see the opportunities to take advantage of that?
That's a fascinating question, is whether the opportunities are going to happen in biotech, or are they going to happen, with the picks and axes again. We also have a funny world where companies don't tend to go public nearly as early as they used to.
Right.
And so if you're looking in longevity, for example, a lot of the really cool projects, they are private. Not only are they private, they tend to be funded by billionaires. And so they're not even necessarily seeking additional capital. So, things like Calico, I think Bezos has his, Sam Altman's got his. It's like in the old days, you had a yacht. Now you have a longevity startup. So a lot of these aren't necessarily investable early on. They're investable on a personal level because the net present value of additional years of life is worth far more than your portfolio.
Right.
But in terms of investment play, that's going to be the question. Does the value go to the sort of biotech analogs? Does it go to, NVIDIA? Or is this something that's just going to be captured like largely AI was? If you look at the large language models, some of them are embedded in much bigger companies where they were already trillion-dollar companies, and so it didn't have that much impact. But largely speaking, there's no way for a retail investor to play Claude or OpenAI or any of these.
Yeah. So let me ask you this then, and then we'll wrap up. Um, this kind of goes back to the K-shaped economy. And if I heard you right, I think you think, okay, you know what? The blue collar folks might on a relative basis do a little bit better over the next couple of years as these policies designed to help Main Street start kicking in, and as AI starts eroding, white collar jobs and stuff like that. But at a very high level, right? We have a system where more and more of the spoils are concentrating in fewer
Yep.
and fewer pockets going forward. And you just gave a really great example, right? And I've heard this from people in private equity where they're like, yeah, in the past, once you had to raise a certain amount of capital, you could only do that in the public markets. They're like, you don't have to now. You can fund a company like SpaceX fully privately, right? And who wants to become a private company if you don't have to, with all the regulations and restrictions and liabilities and all that stuff, right? So it does seem that, like, to your point, like the better and better opportunities are being kept away from the masses. And, increasingly, those public markets are getting funded by the guys with super deep pockets. So it's not even like a lot of people in the private market. It's just a small number of people with really deep pockets. So how concerned are you just in terms of the trajectory of society? And I think with your 80% probability, we're going to go to UBI. I can't imagine that you're a big fan of that, but correct me if I'm wrong. Do you bear a weight of concern of where society is headed here?
Yeah, I mean, so the reason it happened is overregulation, right? You had Starbucks in 2001. You had a raft of anti-competitive regulation in 2008 that basically the banks got their bailouts, and in return, we gave them protection from competition, which is pretty perverse. And so that's largely shut out retail investors, so that a lot of these exciting things, the rich get richer, right? The really massive gains to a lot of this stuff doesn't go to the plebs. Now, that did happen in crypto, and I think that's part of the reason why there's this sort of pirate, revolutionary ethos like in Bitcoin. The rich guys did not make the big money in Bitcoin. You look at people like Roger Ver. these were these were outsiders. These were people who kind of wanted to smash the system. It is possible. It's even possible in crypto.
Sorry, can
If
I challenge that in crypto
Yep,
just a little bit though? I
yeah,
mean, if you look at the ownership of like Bitcoin, you know, it's weighted way disproportionately into a few, really big holders, right? And a lot of those are rich
yeah,
people that once Bitcoin started taking off, they'll say, "Oh, I should own some of this," right? And so
yeah.
it doesn't really seem to have sort of democratized, prosperity. It just seems to be yet another market that is largely lopsided now to the deep pocketed. Yes, some regular
Yeah.
people made
Yeah.
some money along there, but just like people like you made money early in the dot-com who weren't rich. But at the end of the day, it's not like it
Yeah.
changed the prospects for society.
Oh, yeah, for sure. I mean, Bitcoin is much more democratic than, say, OpenAI shares. But right, without a doubt, there were a lot of smart guys who got in later. So, depending where we take the snapshot, like we take the snapshot at 2015, they're almost all ANCAP, revolutionaries.
Absolutely. Yep.
Yeah, exactly. And when you fast forward to today, they're what I think was it Novogratz who bought all the seized Bitcoin. So rich guys who came in along the way have gotten a big share of it. But still, Bitcoin or crypto in general is sort of an archetypal market where you're not shutting out the plebs. Anybody could play it from day one, and it would be great if regular financial markets got like that as well. That would require, more or less getting rid of the SEC, just going back to a fraud only, sort of the pre-regulatory rule where you could do whatever you wanted, but if you actually defrauded somebody, then you would be liable for that. That's not in the cards unless the government collapses and they only have money to pay the army. That's not going to happen anytime soon. So unfortunately, I think that it's going to continue where a lot of the proceeds of these exciting new technologies are going to go to the rich on an investment sense. But you can also sort of step back and ask, for example, so if you think of the ways that the internet makes your life better, right? So almost everybody spends almost all of their waking hours in some form or another on the internet, deriving all kinds of utility and benefit and happiness. And the percent of that was actually captured by investors might be 1%. And I mean, this is true across technologies, right? So, if you're able to, let's say your doctor has you on 6 prescription drugs, and then you can go to ChatGPT and you can say, hey, does this make sense? And then it can say, well, what are your symptoms? And then you can drop that and realize that your doctor's an idiot. Well, that's enormously valuable, but that is not captured by anybody. It's a very small amount of it actually captured by ChatGPT. So point being that, yes, in terms of, the rich getting richer, the fact that plebs are shut out of financial markets, I think absolutely makes that worse. However, I think that is swamped by a factor of 50 by the fact that new technologies in and to themselves are democratizing because the greedy capitalists come out with Google and they want to sell it to everybody. And the way to sell it to everybody is to make it free and then figure out some way to make money on the back end. The end result is that they're trying hard to make all this stuff, whether it's robots or AI, they're trying to make it as close to free as possible because they're greedy, because they want to make a little bit on free. But the end result is that the benefit for regular people, I think over the next, 5 or 10 years is going to be absolutely astronomical. It's going to be very, very good.
Okay. And look, I'm not trying to, be a doomer here. Looking at the long trend, it's sort of like your thing about hair extensions and fake nails, right? For the low end of society. Yeah, those are luxuries that weren't available in previous generations. Are they ones that really make us better off, right? Or is it sort of a modern sort of bread and circuses that just keep us docile? And in this world where more and more, concentrate in the rich, and we're even at the point where the retail housing market is one where we record levels of unaffordability. Is the progression here that we just get kind of a Ready Player One society, right? Where like we get more and more things that superficially distract us from the worries of the immediate moment, but we're a renter nation, and all the meaningful work is being done by robots owned by these rich people, and we're really kind of just unnecessary eaters that are just they want to keep distracted.
Yeah, and that's a much deeper question, and I think it's really important. People forget that, when we talk about GDP and per capita income and things like this, if you look at happiness studies, those are a very, very small amount of happiness. If you think, anybody listening, the average American has something like 4 or 5 careers. So there will have been a point where you were poor when you were young. There may have been a point where you were poor in between. When you think about your happiness, for me, it's not that big of a difference. If you're poor and you have a goal and you have hope, okay, that pretty much does it. You don't actually need anything beyond that. The important stuff, the other 80% of happiness, that's things like family, friends, feeling like your life has meaning, your life has purpose, whether that's a relationship with a higher being or not. And those things, I think, across the board are catastrophically imploding. I spent about 10 years living in Asia, in Japan and Taiwan, and the contrast with the West is just incredible. I moved directly from Taiwan back to Canada, and it's a big difference. Just, nobody's married, families are dysfunctional, kids hate their parents. We saw that during COVID, where it was kind of a running joke that, oh my God, now I have to spend time with my kids. Who are these people? Who are these strangers who live in my house? And, it's a standard trope on TV that, the kids roll their eyes whenever dad says something. Like, this is not the state of nature. This is not how it's supposed to be, right? Parents and kids are supposed to be each other's best friends in the sense of you're on the same team, you love each other unconditionally, everybody knows that, you're there for each other. So, in my family, for example, my wife stopped working. She made a lot more money than I did. She's a lot smarter than I am. But anyway, she quit and she, went to be a homemaker. There's a lot of people now who are saying, if you drop the second income and, you look at, $4,000 house payments in somewhere like Washington, D.C., drop the second income, go out and live in Tennessee, do something meaningful. Now, a lot of that, of course, the internet enables, but, some people go out and homestead. They have little farms. My wife dreams of a chicken farm. I think that's a ton more work than people expect. But anyway, yes, I think a lot of people are waking up to it. And it's an important conversation to have just kind of fundamentally, like, why is our society so unhealthy? When I see a problem, my first assumption is, what did the government break this time? So, I think part of it has to do with public schools that operate like day prisons. I think that the government in many ways has sort of cucked the American male, especially for the lower class, where, they don't need men. They don't need provider men. So if you don't need provider men, you may as well get the hair extensions, go to the club and get knocked up by somebody who's, 6'5", right? Because they're not going to provide either way. I think that a lot of these things can be traced to specific policy errors that could be fixed. Unfortunately, I've been talking about them for 50 years. The idea that the welfare state causes dysfunction is actually destroying families. This has been widely discussed, certainly since the 1960s. And it's not changing anytime soon. Fortunately, individuals are discovering it and they're kind of finding their own lifeboat. So it's another parallel with Bitcoin, that Bitcoin is not yet fixing the financial system, but what it is providing a lifeboat for individual people to save themselves and save the people around them.
All right. Wow, Peter, I feel like I stuck my stick in the ground at the end of our conversation here and hit a gusher. I would love to really opine at much greater length on this topic that we ended here, but I got to sadly wrap it up here in here and now. Again, thank you for such an honest, direct, and very specific answer to that question. As we wrap things up here, most important question for folks that have enjoyed this conversation, maybe this is their first time listening to you, where can they go to follow you and your work?
I make daily videos. They're about 3.5 minutes, and I post them on Twitter or X. At Prof St Onge, and then I also put them up on YouTube, and I do weekly articles over on Substack, which is also Prof St Onge.
All right, fantastic. When I edit this, Peter, I will put up the your Prof St Onge handle on the screen so folks know where to go. I'll also have the link there to your Substack. Folks, the links will be in the description below the video too if you want to get there with one click. Peter, I've really enjoyed this. Thanks so much for coming on. And yeah, if you don't mind, next time you come on, let's reserve a fair amount of time to dig into that societal topic.
Awesome. Yep. Looking forward. Thank you, Adam.
All right. Well, folks, now's the time on the channel. We'll be bringing the partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners there, John Lodra and Mike Preston. Gentlemen, great to see you. John, let's start with you. I'm curious to hear some of your top takeaways from the discussion there with Peter. Some things I think you're going to agree with, some things I think you might disagree with. And then there's been a bunch happening in the market, so we'll get to that shortly too.
Yeah, thank you, Adam. Great to be with you, and nice to hear Peter's perspectives. I think you said it was your first time having him on. That's great. We've come across his writings quite frequently in his work, so appreciate you get to hear him live there and be able to comment here. Yeah, I mean, we certainly do see some things different, and it really I think stems from in no small part what our mandate is. Viewers probably know by now that we're financial advisors to real people and people that maybe have a different objective than the massive investors at large. Peter described his personal leanings to, and I know he said this tongue in cheek, but chase bubbles, chasing the AI bubble, addicted to risk. These are all things that I know he means tongue in cheek, but that's categorically not the way that we see and approach markets on behalf of our clients. Our clients, by and large, are folks that are in or nearing retirement, and their biggest risk, candidly, in this late stage bubble cycle that Peter himself also agrees we're in, doesn't mean it ends right now. Biggest risk in these kinds of environments for most folks in our client seats is unwittingly suffering ultimately a big decline, even if it comes after having chased the bubble. And that's usually what happens in major bubbles. They go longer than valuations would suggest they should. But when they resolve, every time in history, it's been very painful. And usually it's not worth the chasing in terms of what it means to the real financial security of real people that are looking to fund a retirement. So we see things quite different. He talked about the economy and markets in separate breaths, which we often will remind folks. The economy is not the market, and markets aren't the economy. He described his take on the economy as somewhat optimistic. He thinks we're mid-cycle, not late cycle, and he pointed to three main factors. One is the Fed's, maybe becoming less concerned about inflation. I think that's debatable, and even within the Fed, board seats themselves, there's quite a debate going on about, where policy should go. He talked about the Trump's administration's goal to attract foreign investment, and there's been some high-profile, kind of headlines in that regard. And then the growth in AI is all kind of, being supportive of this economic cycle. I think we could probably take another side on a lot of those. It's not a black and white view. But what I would absolutely point out is, regardless of where we are in the market cycle, the financial market cycle oftentimes is different than the economic cycle. And you can have great businesses, great world-changing trends like the internet, for example, that became everything and more than what folks thought it would be, yet it didn't stop the tech bubble from happening. The point being is that the markets had priced in a frivolity and an optimism that was way beyond even the reality of a great world-changing paradigm. So we are clearly, in our view, in a very late stage cycle of the markets. Peter did talk about the recent risk off of a lot of things together: gold, Bitcoin, stock market, things like that. And he kind of kind of pointed to that as being indicative of a liquidity issue, and the Fed's I guess more dovish tilt lately maybe being a nod to that. There's actually very good evidence that it's not so much a liquidity issue, but maybe signs of a real credit issue. There are some real concerning credit things coming on the radar here. We've talked a couple months ago, we talked about First Brands and Tricolor, for example, lenders to subprime auto borrowers. More recently, we've seen a lot of headline troubles in private credit markets. Just today, a company called Blue Owl, which is a private asset manager, and they get into all kinds of, and it's an interesting company because it's not only private credit, but they have specific focus in technology lending, build out of the AI infrastructure. And that stock and the funds that company manages have been really under pressure, a lot of pressure. In fact, just today, they scrapped plans to merge two funds to try to solve a liquidity issue in their funds. and they called it off because the stock got punished. These are things that are starting to, I think, really spook markets, and I think certainly have the Federal Reserve spooked. And you look at all the main, big private asset managers, folks like Blackstone and Apollo and Carlyle and Brookfield Asset Management. These stocks have gotten hammered pretty good of late. And these are signs of something other than just concerns about liquidity, some real, fracturing in kind of the credit markets, which a lot of times stock market bubbles end with a credit crisis, from the fringes out. We can't avoid talking about Bitcoin and what that has done in recent. It's been dropping like a lead balloon, so to speak. Peaked back in October, I think, at 126,000 thereabouts, and just today it got back down below 90,000. And it's really emblematic, I think, of a risk off kind of moment. And related to that, the shares of MicroStrategy, which Michael Saylor's company have plummeted. There's just lots of signs of risk off, and we're starting to see it in our broad market indicators. So I'll pause there. We got a lot we can dig into there, but those are some big picture takeaways. We definitely
Sure.
are less sanguine about the economic cycle and as relates to where we are in the financial market cycle.
Okay. I think you would agree, though, with the question that I asked Peter, which is if the market were to suffer a substantial correction, that would likely have a big knock-on effect on the economy, maybe one, potentially as large as triggering a recession. Would you agree with that?
Yeah, not only do I agree with it, but that's what happens in history. And they're kind of interrelated. Recessions don't get called until after the fact usually, but the evidence starts but yeah, absolutely. I think the psychology of economy is largely driven by the financialized economy, the financial markets. So I totally agree with that.
Okay, I want to get back to the private credit in just a second. Mike, I want to come to you for a second because while I was interviewing Peter and you guys were listening to the interview, the NVIDIA's results came out, and we've had this sort of risk-off downdraft in markets recently. Tell us what happened in NVIDIA, and maybe that might actually change the short-term trajectory here.
So we'll see, Adam. I'm going to bring up a chart, a minute-by-minute chart of NVIDIA and what it's doing after hours. They just reported just a few minutes ago, and I know this video will come out a little bit later, but the stock is trading up. They beat expectations by about 4%, is what the headline number says. Margins look pretty good. Sales, I think, were a little bit better than expected. We're right around 192.50. Let's go to a daily chart. You can see that a couple weeks ago, NVIDIA broke out here at 195, went to new highs, and then just kind of pulled back, like the whole market. The whole market pulled back in the last couple of weeks, and it feels worse than it really is. The S&P 500 is off around 5%. The NASDAQ or the QQQ is down around 7.1%. So a relatively mild pullback, though it's felt a little bit worse because a lot of the momentum names have really been getting pretty smashed, particularly in the AI space. And so
Right.
everyone,
Sorry to interrupt, but because the market is so reliant on them now, as those stocks go, kind of everything goes.
absolutely, as those stocks go, everything goes. And so everyone's looking at NVIDIA. It's the most important company in the world right now. And so if we hold this trading up at around 192.50, 195, if that can base and start to break out to new highs, then we could start to see some of the other names come up. Palantir has been hit pretty hard. That's down on the other side of its Bollinger Band. But if you just take a look at the QQQ, you can see that it's been on a few week pullback, 7.1%. Not a big deal overall, but
And for folks that don't know that ticker, that's basically tracking the NASDAQ.
yeah, that's the NASDAQ 100 essentially. So it's been a pretty mild pullback, and looks like if this holds with NVIDIA, NVIDIA will probably drag the market up. Whether that will cause the market to come out of its base and go to new highs, we don't know, but it's a good first start for the bulls. Let's put it that way, because there's been a lot of fear, as we talked about in AI and Bitcoin and things like that. And fear can build a wall of worry, and it can refill the engines or the gas tanks so we can power higher. We'll see.
Okay, and so I mentioned that, and look, when this video goes live tomorrow, folks will know a little bit more because they'll have had the NVIDIA earnings call. And really, with stocks these days, it's less what your performance for the quarter was, and it's much more about the guidance that you're giving the street. So we'll see if the street likes as much the guidance that NVIDIA gives. But yeah, I asked that just because, we're approaching the end of the year. There's the proverbial Santa Claus rally. I've had a number of technicians on this channel, over the past couple of months saying, hey, we think we could see some weakness in October and or November, but we would use that as a buy the dip opportunity to then ride the Santa Claus rally into the end of the year. Is that what's going to happen from here? We don't know, but an NVIDIA beat would be kind of just what the market needed at this moment to try to reverse its near-term fortunes where it had been drifting down, like you were saying there, Mike.
Yeah, and I'm watching Nvidia here. It's trading up above 194, almost 195. I don't know if the earnings call has started yet or not, but it could literally be the catalyst. And there's a lot of worry that's been built up over the last couple weeks. Now, we would not be ones to say that you should go all in here betting on a Santa Claus rally, but it wouldn't surprise me to see a squeeze higher Santa Claus rally and maybe even a further blow off top. We've been talking about that as a possibility. We're not trading from that perspective. We're still only at about 45% equities in our model, and we even have an index put down below just in case we're wrong and we get a crash here. But because valuations are obscene, we've been talking about that for a long time.
Hmm.
But still, this is exactly what you'd want to see to potentially start something. It may be Bitcoin rebounds from these levels. Bitcoin's off almost 30% in just a handful of weeks. It is indicative of risk off, like John just talked about. But if that were to stabilize and bounce along with an NVIDIA beat and maybe the Nasdaq and the S&P turning up off of their moving averages, they're just below the 50-day moving average right now. If they were to recapture that and close above there, we could easily see a squeeze higher because there's still a lot of FOMO or fear of missing out in this market, and it's because it's been going on for so long. And everyone knows that the Fed wants to bail out every single dip, and as Peter was talking about, every small dip or emergency has been met with bigger and bigger expansion or larger expansion in government and Fed response, and the market knows that. So it's hard to break that cycle until, in my mind, you get some kind of blow off and then ultimate crash, which is what I think is going to happen. I know Peter thinks that for the next 2 to 4 years, we're going to be okay in the market. I think we would take the other side of that. I
Yeah.
think
Although, just to be clear, he said 2 to 4 years be okay in the economy. He didn't necessarily say the markets, but
right. Okay. Well, we all know that those normally go relatively hand in hand. I think that really short term, the market might be okay, but I wouldn't bet on it being okay throughout 2026.
okay. All right. Well, look, we'll know a lot more by the end of next week in terms of whether there's a return to the risk on trade from here. But I just want to flag this for folks because, I have heard a growing chorus of people saying online, okay, well, this might be it. This might be where everything, starts to really tip over here. And who knows? We'll watch and see. But if you are looking to commit a lot of capital to playing the downside here, be very cautious, especially with this apparently positive NVIDIA results here. All right, John, I wanted to come back to you real quick just to talk about private credit because that does seem to be something that we're hearing more and more about. And there was you were talking about Blue Owl.
Yep.
So I have a chart. I'll try to pull it up if I can, but it shows that. Let's see here. I'll pull it up here. Yeah, that while the S&P, has powered higher over the year, the stocks of the private credit funds have actually really been suffering since summertime. And Blue Owl, so the S&P is the green line here. Blue Owl, the company you mentioned, is the red line here. You can see that something's going on there, right? That the people that have been following this industry are beginning to see some signs of real concerns. And we've heard from a number of different private equity companies of late. They've had some companies that they had lent to that have gone belly up, basically, right? Whether that's the First Brands or was it the recent one, Renovo, I think, where I think BlackRock had it on its books I don't know, as recently as a month or so ago at 100 cents on the dollar, then it went to 0 cents on the dollar. So, you're starting to see some concerning defaults in that space. Um, but anyways, so increasingly, the investors are starting to put their money where their mouth is here, and of course that's raising all sorts of questions about counterparty risk and just the health of the sector, right? Which is, hey, this has been a lending ecosystem that has really grown dramatically over the past 5+ years, but it's not regulated, right? We don't really have any transparency in there. We're just hoping these people have been making good loans, right? And we're starting to see, well, their track record's not perfect. So of course the question is, how much less perfect does it get from here as we learn more? And as lenders start getting more and more worried about the private credit market, well, they're going to be less likely to lend, and that'll slow the economy, but they might be less likely to lend to each other. And when that starts to happen, when lenders start to distrust each other, that's when the credit market kind of starts to slows down or maybe even freezes up. And that's when you get really big problems. And I'm not saying that we're there by any stretch at this point. I'm just saying we're starting to see signs that this space that had a lot of probably overconfidence in it, people are really starting to get nervous and jittery. And John, I know you're nodding. I know you probably want to say something, but real quick, let me just share one last thing, which is, I think I told you guys about a month or two ago that I'd seen that PayPal, they've built their own buy now, pay later service, so that you can make your payments through PayPal on a buy now, pay later basis. But they sold their book of buy now, pay later loans, right? And I remarked at the time that was probably a pretty good sense that they said, hey, look, we're making these loans. We know that these things are going to eventually blow up at some point, right? Well, what company did they sell them to? Well, they sold them to, let me show it here, to Blue Owl, who you were just talking about, John, right? So, Blue Owl has had this apparently sort of voracious appetite for private credit, looking like maybe all across the spectrum of borrowers. Maybe it's not a huge surprise that they're starting to get into more and more trouble here.
Yeah, it's exactly right, Adam. And it's not just the problem with this kind of stuff. If it is deeper and broader than it appears that we're already seeing in the headlines, and I think there's a good chance that it is. It's what are the spillover effects? And I'm gonna reshare a picture that I shared last week in our video with you, just to reemphasize this. This is so let's talk about the insurance industry. Many insurance companies, to match their liabilities. You think about what insurance companies do. They basically have to pay out insurance claims or guaranteed benefits to insured parties, right? And traditionally, they would use treasury bonds as the vehicle to do that. Now, when interest rates got depressed really low, the insurance industry basically went out to the private credit market where they could find higher yields and be able to match those liabilities. And it's all well and good until it's not. And this is a chart that was put together by Moody's and a couple other folks, and it basically shows the tremendous amount of private credit instruments within insurance companies, balance sheets, basically. And just as concerning, I think, is the rise in kind of privately rated securities. And UBS's chair was, I think, three or 4 weeks ago, talking about they're starting to see this kind of like gamesmanship in credit ratings, just like we saw in the housing bust, the subprime housing bust, where in effect, the insinuation is that the issuers are paying to play, or the kind of the rating agencies are getting paid to play and softball rate these issuances, and it's just this kind of stew of stuff, and a lot of these loans, these private credit loans were issued with no or very light financial covenants that are traditionally the ways that bond investors protect themselves. So it's a tricky thing, and I think we're going to see more of this, and I think the market has a way of sniffing this out. Even if you look at broadly just more publicly traded financial stocks, we're starting to see some stresses there. We actually own a sector ETF in financials. It's not in danger zone yet, but we're watching this here because, and I'll share a chart of this. This is ticker symbol XLF. It's an ETF that holds financial stocks. This is a daily chart of that. We've seen a pretty dramatic pull off here. We sliced right down through. We've been trading pretty consistently below the 50-day moving average. We're down right around the 200-day. This is a very important level to keep here. It's not, you zoom out, it's not big damage yet, but this has the potential to roll over and be a harbinger of other things to come. So we're watching things like that very, very closely because they oftentimes are the canary in the coal mine speaking to a broader issue. And just if I could, just for a moment, I'll just share a glance at some of our indicators. We agree with Peter that bubbles don't end on valuations; they end on other things, and we look for that as the market tells us or can tell us clues as to when that is likely to happen or is happening before our eyes. And this is just a simple dashboard of some of our indicators. We look at a bunch of different breadth indicators, for example. This is just a subset of those. We can look at it across different indices. So we got things like bullish percent of stocks above positive trend lines, and then participation indicators above different duration moving averages. And we've seen a broad-based and consistent erosion of all these things across all these markets. Even though the indices themselves haven't really seen a whole bunch of damage, we've seen the S&P 500, for example, if we go to that, it traded, if I go to a daily chart here, we're trading now below the 50-day moving average. We'll see if it stays below there or starts to turn down. That would be another checkbox in the time to get a little bit more concerned category. So we're watching things very closely. A lot of sectors, a lot of charts are at really important toe holds, and if they don't hold here, it may signal a broader risk-off moment.
All right, and I'm going to guess that that's going to make what happens in the next 48 hours with NVIDIA really super important here, which is, as you just said, there's a lot of indices, a lot of assets, sectors that are kind of at like breakdown thresholds, right? They haven't broken trend yet, but they're close, right? And if NVIDIA is enough to save all this, then great. Okay, I mean that tells you, okay, then the direction of the market probably for the rest of the year is more likely to be up than not, and it's maybe risk back on comes into the market. But if it's not, if NVIDIA, no matter what happens with that stock specifically, if it's not enough to reverse these trends and you start getting a breakdown despite NVIDIA delivering the best results that it can, I'm going to guess that speaks really loudly to your level of concerns of what would happen next.
It does, Adam, and everybody focuses on the headlines, the technology headlines, and the S&P. What's the S&P doing? But there's a lot of stuff going on beneath the surface. And if I can indulge, I'll just share one more chart here to give you a flavor for what we see here. So this is just a simple way that we rank different sectors and different scores. I won't get into the multifaceted ways these scores are built, but higher is better. You can see right at the top are some of the areas we've talked about for some time as being areas that we have exposure: precious metals, utilities, technology. And what we can do here is we can look at the change in these scores over the last 6 months. And this has been more recent than later. But what you have seen here is there's been big gainers here in things like healthcare, biotech, precious metals, commodities, basic materials, energy. And some of the areas that have lost ground, you can see here they've actually lost ground: financials, technology is down kind of mid-pack here. There was a not so subtle shift that's been playing out under the surface here that at the very least speaks to tactical rotation opportunities, but it also could very well speak to a more durable changing of the guard as relates to what this market has been built on.
Okay. Really interesting chart there, by the way, John. Maybe next time we can go a little bit more into kind of if the torch is getting passed as we enter 2026, which sectors you think might benefit the most from that. But real quick, Mike, let me come to you. Just give a quick update on the precious metals. I think the question on most people's brains right now who follow the precious metals is, hey, they've hung in there, which is good, but they've kind of been trapped in this range. And today's even a really good example where, they were up big, but then they kind of drifted down throughout the day. They still closed up, right? Silver's still above the $50 an ounce threshold, and gold is still above 4,000, but they haven't quite been able to get back up to their highs either. So from a technical perspective, is this positive? Like, oh, this is it's relative strength, and it's maybe consolidating and getting ready for another move higher, or is it, hey, these things are trying to get back to their old highs, but they're failing, and that could be a sign of decreasing momentum.
Hey, Adam, at the risk of being too overly positive, I think this is exactly what you'd want to see in gold and silver and in the miners. If you're a long-term bull, there's no doubt a month ago that the trade got really hot. We were talking about that, talking about it with clients, telling people to sell a little bit on the way up just to loosen up psychologically. Gold bugs, so to speak, oftentimes put way too much in gold and silver, never sell anything, have it their whole life, and it's really hard to loosen your grip on that thinking. And so selling on the way up makes sense. And if you did, it made what came after a little bit easier. So I'm going to show a chart of the daily chart of gold. And you can see about a month ago on October 20th, we hit a high up here. That was around $4,400 an ounce. This happens to be ticker symbol GLD, which is, the shape of the curve is the same. But then for about a month now, we've been consolidating sideways. We never hit this 50-day moving average, which is the green line. So we were walking up along the two standard deviation Bollinger Bands, and we came in. We never hit the 50-day. We've been consolidating sideways. And just a couple days ago, it looked like we were going to very quickly break out to new highs, especially on silver. I'll show you that here. It looks very similar. But we should be kind of glad that it didn't, I think, because it actually builds a lot more energy and power. If it goes up, if it comes down, if it goes up and it comes down, it's building or energy or coiling. And if we break higher here, it's going to be a powerful move. Silver too stayed above its 50-day moving average, and we're just above $50 an ounce on silver, which is huge. Now, the silver miners are lagging a little bit. Let me show you SIL, which is the silver majors. It's floating right around the 50-day moving average, and SLIJ, which is the juniors, right around the 50-day moving average. I drew this downtrend line thinking it was trying to break out of here, and now it's come back to the 50. Silver at 50 bucks an ounce has got to be huge for these guys. I'm not an analyst or an expert about the financials, but it seems like maybe the market's not sure that silver is going to stay up here or gold is going to stay up here because the miners, let me show you some of the miners. They performed fantastically, but they too are consolidating sideways. There's the gold miners. I showed the silver miners a minute ago. And if gold and silver can stay where they're at and break higher, I can only think that these miners are going to go quite a bit higher. As we've said a few times before, that a big bull market, and here's a monthly chart of GDX, really broke out around 40 or so. It doubled up to 80, and now it's consolidating sideways. Wouldn't be surprised over the next year or intermediate period of time to see that double again long term. But what we need is for gold and silver to stay up here and for the market to be convinced that it's going to stay up here. So I'll stop sharing a chart, but a few more comments. Silver itself is on a massive triple top. Now, maybe it doesn't matter because it's been so long, but the Hunt brothers cornering the market in 1980 drove silver to 50. And then it just kind of consolidated for decades. Then it hit 50 again in 2011, came all the way back down to into the teens. And here we are at 50 again. So 1980, 2011, 2025, 45 years. And the other times, if you look at charts, you see that silver collapsed relatively quickly. I know it's pretty early, but a month into this correction, we haven't collapsed. We're sitting around 50. And so imagine if it can base sideways and break higher from there. It'll be a massive triple top. And like the triple top we talked about at silver a few months ago back at 35, triple tops don't normally hold. They're normally broken. And so I think the miners have quite a bit more to go, probably more percentage-wise than silver and gold. Silver sitting here at 50. Wouldn't be surprised to see maybe 70 in the next year based on the charts. Gold at 4,000, maybe 5,000. These are guesses based on the charts, and so take that with a grain of salt. But that would imply around what 25% up for gold and maybe 40% or so up for silver, and much more for the miners. As always, position sizing makes sense. Don't go all in. Talk to us if you want some advice about your particular situation. but I don't see any real reason to be concerned, nor do I think people should get overzealous here. A lot of our clients got a little bit over their skis, and we're wanting a little bit too much too fast. So keep your expectations moderate, your position sizing moderate, and just sit back and let it work. So the last thing I guess I'd say is looking at some screens like momentum names. There's a lot of gold names on momentum screens. They have persisted. They've persisted for months, and they're not falling off. Those we've seen some tech rotate out of those screens. We've seen biotech come in, but consistently throughout the last few months or more, miners have been there and probably will stay there.
All right.
Adam,
All
if I
right.
can just add a little context to some of Mike's strong comments on gold miners. And this is a piece that we dove in our investment committee here in the office yesterday. And I want to give some props to Van Eck. I know you have Jan Van Eck on your program periodically. This is their lead gold analyst, Ima Casanova. And I urge, invite folks to go to their website to read this public available piece, but it's their October 25 commentary on gold. And I just want to call it a couple charts. So it's fair to ask, hey, this big move in gold miners, does it mean they're overvalued? This chart is Van Eck's work in this regard. It shows that the gold miners, even though they're at the higher end of their 5-year range, which is this gray bar, the blue dot is the current dot, on an enterprise value to EBITDA metric, they're far lower valued, lesser valued, more undervalued, if you will, compared to the S&P and the Mag 7. And same with the price to cash flow. And the cash flow is key for these because it really comes down to the cost of the production. As the price of gold goes up, these companies have very high operating leverage, and their cost of production doesn't go up, one by one with the price of gold. And this chart, I think, is really important. It shows, for example, these are the gold production as a percent at different all-in sustaining cost of production. So the way to read this chart is 70% of the gold miners have sustaining cost of production of about 1,700 or lower. With gold prices at $4,000, if they're producing at 1,700, that's a boatload of free cash flow. Even here, you have 95% or so with sustaining cost of production just a little over 2,500. That's still almost a $1,500 per ounce margin, right? So that's a really compelling picture as to why these stocks probably have a lot of further run to go, even if in a risk-off moment they get thrown out with the bathwater. There's some really good numbers we found in that research, and just wanted to highlight it for your review.
Yeah, no, I really appreciate it. Those are great charts. I'm glad you showed them. And it just shows, especially those ratios, just how hated this industry was. That even though it's this year delivered just blockbuster results, Wall Street is still looking at it like, okay, I guess we'll put a little bit more money your way. So yeah, a lot of potential room to run further to the upside, if indeed the metal prices hang in there, Mike, as you said, and that's the key thing here. But it's nice to see that technically you're as optimistic as it seems like you are, given what the technicals are telling you. All right, gents, we got to start wrapping it up here real quick. I'll let whoever wants to take this one answer it. So, end of the year is coming up. As Mike said, look, if you've got questions about how to invest in the precious metals miners and whatnot, call New Harbor. They can give you, they can listen to your situation and give you customized guidance. But as you guys have said in some of the recent videos we've done, another good reason to give your financial advisor a call now is for the end of the year, the things that have to be done by the end of the year, right? Like tax loss harvesting and charitable giving, required minimum distributions, that type of stuff. Okay, above and beyond the market related stuff, like, is this a good time to buy X or sell X or whatever? What are some of the other things that you guys discuss with customers? I mean, there's their whole financial life part of it, like what the money is for, beyond just, hey, what might the stock market do next month? So I know you guys talk to your clientele on a whole spectrum of different topics, but like, what are some of the other major things that you guys spend your time talking with customers about beyond just where to put the next incremental dollar in their portfolio into?
Yeah, Adam, really, if I could boil it down to this, it's really about taking away the fear of the future, which sounds like a tall order, and it is. But at least as it relates to money and financial matters, it's all about reducing anxiety, taking away the fear of the future, convincing people that they have enough. This is very, very difficult to do because we as humans are just wired to always want more. And it doesn't even necessarily have to be blamed on greed. It could be blamed on survival instinct, because if you give a squirrel a chance, they're probably going to, keep storing acorns until, wherever they're
Right.
storing them bursts,
They'll die with a tree full of acorns. Yeah.
Yeah, it's just natural. You don't know what tomorrow brings. You don't know how long you're going to live. You don't know how many acorns there's going to be available. So it's about taking away the fear of the future. And I think the only way to do that is really one of the ways to do that anyway is to talk to someone like us that has now, believe it or not, 25 plus years of experience, John and I have, which is amazing. We're getting old quickly. Life goes by fast. But one of the benefits of that is that we have the experience. We've been through a lot of things over the years, personally and professionally, and we've been exposed to thousands of clients and situations. And we just know in our being if somebody is going to be okay or not based on a quick look at their situation and what we think about the future. We've got a lot of confidence in our ability, if we're managing money for the person that we're talking to, of not losing the money over this market cycle. And we think this is going to be a climactic, high risk market cycle. And so we can look at the other things like their guaranteed sources of income and make some adjustments if needed, but give them some real security about I'm going to be okay. Letting go of that fear and anxiety is extremely hard. And I hate to say that we're therapists because we're not licensed therapists like your wife is, Adam, but we end up being financial therapists a lot of times, and so we're good at it. We like doing it, and I think we do a lot of good when we talk to people. So that's what it's all about. At the end of the year is the three things that you said: charitable giving, gain loss, required minimum distributions, and maybe a fourth thing, Roth conversion discussions. But the bigger picture is, am I going to be okay through this market cycle no matter what happens? Can I let go and stop worrying? And can I spend more? And a lot of times we're telling people to spend more because that's what life's all about. If you have a huge pile of gold and you have got more than 50% of gold and silver, like some people we talk to, sell 10% right here, even though I think they're going higher. Use that to do some work on the house, go for a bunch of vacations or whatever, or one big vacation, whatever floats your boat, so to speak. But it's really all about psychology. It really is.
That's a great answer, Mike. And right there near the end, I think you got to kind of what I was sort of envisioning, which is, you know, when I go to events, people come up to me and one of the things they often express is like, oh, it's just so great to have somebody to talk to about money. I don't really have anybody in my life to talk to about money. And so we tend to wrestle with these decisions around our money, alone, and it feels isolating and overwhelming for a lot of people. And yes, a big pervasive question is, well, how much should I be putting away and what should I put this money in? But then to your point, Mike, it's like, yeah, but those are all steps towards something. What are you doing it all for? What's the why, right? And so to be able to talk with somebody about, okay, well, look, we're thinking of doing a remodel. Like, how much can we realistically afford to spend on it right now? Should we be doing that given our current, income situation? I want to help my kid out, or my parents need some help. I'd like to give X, but is that wise? How much do I have to be generous this year? That type of stuff. I mean, just kind of all the basic blocking and tackling of how to use money to enrich your life going forward. You're nodding as I'm saying all this, Mike, but this is sort of what you guys do a lot of beyond just okay, here's what I'm going to put the next check you gave me towards in your portfolio.
Yeah, and I don't want to overstep our importance. I mean, it's not like we're gurus or anything. There's a lot of people that are better at psychology than we are. But in this unique niche, this space where it comes to fear of money or not having enough, or not being able to let go of that anxiety, we are uniquely positioned to help. And that's what feels good about this job a lot of times, that we can do that.
All right, great. Well, this is one of the great things about the consultations, which I'll mention in just a second. But if folks have some questions that they're really wrestling with right now, even if they're not clients of yours, they can call and have a conversation about it. John, anything else you want to add to Mike's answer before we wrap this up?
No, I think Mike really hit the nail on the head. We have all kinds of nuts and bolts we walk through. In fact, we're getting ready to send out a year-end checklist email to our clients, all the kinds of nitty-gritty things we can and should be covering with them. But it really gets back to what Mike just talked about. It's about filling those voids of fear and stress in clients' lives and minds with some just open discussion as relates to their situation.
All right. Okay, folks. Well, first off, if you enjoyed having Peter St Onge on the program, would like to see him come back on, please let us know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a good professional financial advisor in terms of, whether it's ways to invest that maybe might take advantage of some of the opportunities or challenges that Peter mentioned, or whether it's more the nuts and bolts of what I was just talking about with John and Mike here about just like, hey, I've got some big questions in my life about what to do with my money, and you'd like to get some professional advice about that. Then if you don't already have a good advisor who's playing that role for you, consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to even John and Mike themselves there at New Harbor. So to set up one of those discussions, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These discussions are totally free. There's no commitments expected or involved. It's just a service these firms offer to help as many people as they can. John and Mike, great discussion this time around. Looks like the next week will be an important one in terms of whether we're back to risk off on or whether things fall more into risk off. But no matter what happens next week, look forward to making sense of it with you guys. And I really wish both of you the absolute best of Thanksgivings next week with your families.
Well, thanks so much, Adam. Always great to be with you, and to you as well, and of course to all your viewers. It's a great time of year to be thankful for so much we all have in our lives, even if we forget it sometimes.
Thanks for watching, everybody. We really appreciate it. And thank you, Adam, for the opportunity to be here every week. We'll see you next week.
All right. Thanks so much, Mike and John. Everybody else, thanks so much for watching.